Hello and welcome to the Kingsview Investment Strategies Q2 Portfolio Review and Q3 Markets Outlook. My name is Scott Martin, Chief Investment Officer and Portfolio Manager at Kingsview Investment Strategies. Joining me today, once again, familiar face, Paul Nolte, Senior Vice President, Portfolio Manager at Kingsview Investment Strategies as well. Paul and I run portfolios with Kingsview Investment Strategies and are here to discuss with you some of the recent machinations in the portfolios, Paul, as well as maybe some of the recent movements in the markets and how they're relating to what we're doing within our individual investments. So let's start off, Paul. As we shoot this today, it's July 9th, and we've already passed July 4th, which means summer is what? Pretty much over by now, right?
Oh, yeah.
Which might be good because the summer's been an interesting one, I believe, from the market standpoint. We talked about a lot in our previous videos that we've done, which I've enjoyed very much, by the way, Paul, about market volatility that was out there kind of early on, and how early on in the year there was a lot of market volatility, a lot of asset class, I think correlations broke down, a lot of kind of interesting behavior in several asset classes. And now we've kind of, I guess, lulled into that summer trade so far. But then of late, it seems like with trade wars, tariff talk, and now a Federal Reserve, which is set to raise interest rates maybe a couple more times this year. Talk about how that's been impacting the market somewhat.
The fireworks haven't ended just because we've gotten past the 4th. So if you take a look at what we're seeing kind of impacting the markets, we saw the volatility trade. We're seeing emerging markets and international falling apart. A very strong dollar, which is not intuitive given all the trade discussions. We don't know what the impacts are going to be coming out of all of the trade discussions, and the markets are kind of looking beyond that right now, anticipating that we're still going to get very good earnings this quarter, next quarter, 5% month over quarter over quarter,
Yep.
and then 15% year over year.
I've even seen 20.
So
Can you believe that?
I mean,
Right.
so
Depending on the industry.
They're really looking at the tax implications and the tax benefit from the tax cut that we got earlier in the year as really being the driver, and not looking at tariffs at this point. So that's really the dynamic. Behind the scenes, tariffs are going to be a cost. Interest rate going up is going to be an additional cost. So we're starting to see some things that are in the background now that will probably work their way to the fore as we get through the course of the year. So the fireworks, even though they may have ended last week, I think we're still going to see some more between now and the end of the year.
Yes, and a little aside, the Chicago fireworks, I believe, were rained out even. I mean, the one day it rains was actually fireworks night recently, of course, of our luck. And speaking of that, and the group that we have here in Chicago, Paul, at Kingsview Investment Strategies, or KISS as we like to call it, and the portfolio allocations that we've had over the course of, gosh, I mean, the last 6 to certainly 12 months, but even maybe more recently in the last 3 months, let's talk a little bit about some of the things that we've done within the KISS portfolio specifically to address, say, some of those headwinds or some of those uncertainties that have been out there because of the trade wars or because of the Fed and so forth.
Well, I mean, if you take a look at it, our base thesis is we're late innings of this expansion. We're 9 years in. It's the second longest on record. We're not anticipating this to go another 4 or 5 years. So if you're late in the economic cycle, you really want to start to reduce a little bit your technology weight. And we've been very overweight technology, and it's
Cyclical stuff, yep.
It's worked great for us.
Yep.
We've moved a little bit more toward commodities and more of an inflation bend, if you will, over the last few months. Raised a little bit more in cash. Not quite getting defensive yet, but again, looking down the road and anticipating that will be our next step, and making those changes to the portfolio to take advantage of the current environment. So those are the couple of things that we've looked at. And really, when you look at it from a short-term perspective, we may have said, well, you've been a little bit early on this trade, a little bit late on that one. Again, we're looking out over 3 to 5 years, not 3 to 5 weeks.
And I think by and large it's been pretty accretive because what's happened with a lot of those movements is we've reduced volatility by and large. And that to me is really somewhat the large name of the game here, is because with respect to how the market is digesting and depending on what mood the market seems to be in on a given day, a lot of those changes that we see in prices have to do with basically the mood the market's in and which way the wind's blowing, frankly. So, one thing that I think is interesting about what you mentioned about the bond side of things, interest rates, the Fed kind of, maybe not totally going full bore on a bunch of interest rate hikes going forward, watching inflation closely, keeping an eye on growth trends. We have a piece here that we call the recession risk ratio, right? So we call it R3, recession risk ratio. Say that 3 times fast, by the way, at home. And talk about how that is leading us a couple different ways with respect to, say, the shape of the yield curve, which is big news nowadays as the curve is tending to flatten out a little bit.
Right, and that's the one that everybody points to is the yield curve as it flattens, short rates getting equal to or certainly above longer term rates. We throw in a few other things like inflation, the unemployment rate, and those types of things. It gives us an idea of when we might be expecting an economic slowdown. And right now, the projection is that should trigger sometime second half of this year, which doesn't mean a recession starts right away, but it means that we now are on recession watch for maybe mid to late 19. And why that's important is because the markets will anticipate that. And we would then start to see softness in the equity market and conversely, strength actually in the fixed income market.
That's one thing I tend to worry about is us being portfolio managers at Kingsview Investment Strategies or KISS is the market knows.
Mm-hmm.
I mean, the market is obviously a future discounter, and you have to figure that a lot of these growth trends and a lot of this great earnings growth that you talked about earlier, Paul, is factored in.
Mm-hmm.
So when the market starts to see, and not that the market's going to necessarily follow step by step our R3, our recession risk ratio, our proprietary work there, but the market is going to start seeing some warning signs, and there is going to be, say, some at least I would say risk pairing in the markets when that stuff starts to show up. One thing you mentioned before we go that I think is really interesting: the dollar. What the heck is going on with the U.S. dollar as we've gotten into trade wars with, I guess, people we thought were our friends around the globe, as we've seen the economy, I guess, grow in some stages and kind of level off in others. What do you make of what's going on with the greenback?
You know, it's interesting because the dollar is strengthening on the fact that our growth is probably better than most other countries, say for China, around the world. We're getting support from higher interest rates. But the trade wars and the implication of those trade wars should actually weaken the dollar. We should see actually weaker economic growth around the world. We're starting to see some of that early signs right now. So we would expect to see those come off. And certainly with the trade dollar, the higher dollar is going to hurt our export markets, which again is not going to help our trade deficit. So again, we may do more tariff discussions later on this year. So those are all the things that are going on right now, kind of behind the scenes, that lead us to believe that the move in the dollar is short term.
Okay.
So the international markets have certainly been hurt as a
They have.
result of that. That's actually changed just in the last week or two. So since the end of the quarter, the international markets have actually been one of the better performers.
That's right.
So again, I think it's a shorter term move. Again, going back to the discussion of the 3 to 5 year window that we're looking at, the dollar we see as being a weaker currency.
And an interesting concept on that is if you look at S&P 500 stocks, a lot of the earnings, or about half of them or so, are overseas, right? So you have an impact directly from the stronger domestic currency here in the United States that, to me, is going to be still one. I know we said it's short term, but still one that we have to watch because that's certainly a big impact. So going forward, definitely watching international markets, watching the yield curve. The last time the recession risk ratio, which is heating up, let's say, or starting to maybe flash maybe a little bit closer to red, let's say. And I think going forward, too, like you said, the commodity allocations. You know, we talked about some of the commodity stuff that we've had in the portfolio for several quarters now, and then recently a little bit more exposure to energy. Those have been very accretive to the bottom line. They've actually provided on some down market days some very good non-correlating asset performance. So if you have any questions or any further thoughts about what we discussed today, please reach out to your advisor. As always, we look forward to talking with you about these very important market topics. Paul, thanks again for joining us. Take care.
Enjoy.